So everybody knows about buy-sell agreements. I'll cover it quickly. I've added in something that you don't see in most of these presentations. In fact, I've never seen it, and I've built it because I use it a lot for small businesses, really small businesses. You know, businesses that might be 5 to 10 million a year in revenue or less. And this is sort of an alternative to doing the full-blown business succession plan where we bring in the valuation expert, and we bring in the family counselor, and we bring in, you know, a CFO, an interim CFO to come in and basically project out the future of the business. The business may not be susceptible or capable of that. It may be something that is just going to keep going at $5 or $10 million a year, but we want it to successfully do that after the founder retires. So we'll use a management succession plan. Tools we use in addition to the buy-sell agreement might be a grantor retained annuity trust, an intentionally defective grantor trust. Again, that'll be covered heavily in the next boot camp session because we're going to talk about advanced estate planning concepts in the next estate planning boot camp session. But today I'll just cover it generally just to give you an idea of why it might make sense to use it. And then an ILIT, an irrevocable life insurance trust, using life insurance as a wealth replacement tool to equalize the estate for the kids that aren't in the business, for the ones that aren't going to get the upside of the business and running the business, okay? The buy-sell agreement, it's if I die or become disabled, my partners will buy me out. Simple. That's what a buy-sell agreement is. Or the company will buy me out. What if you don't have any partners? Silence. Huh?
It wouldn't work.
It might work depending on what you do to help it work. What would you do?
You should have it with
Let's say
a
you're
competitor or someone, you know,
a
that has
competitor?
the same kind of business.
You could, but I'm not sure I would enter into an agreement with a competitor. Because the competitor then would gain insight into your business and might use that against you competitively. And then if you entered into a non-compete, I don't think they would do that. I mean, why would they limit their opportunities, right? Let's say you're the sole successor to your family business and there's nobody else involved.
Usually insurance.
Well, insurance is just a way of getting liquidity to somebody. So I'll give you an example of how a buy-sell agreement recently worked really well. Really well. Company, 3 owners, co-equal, not related. They went out and bought insurance on each other, so they had a cross-purchase agreement where they entered into an agreement with each other to buy each other out using life insurance proceeds. They agreed on the value of the business. They didn't go out and get a valuation. They said, I think it's worth, each interest is worth $500,000. Great. So they got a $500,000 insurance policy on each other. One of them got sick. He died. This just happened. The widow got the insurance. She gave up the stock. It worked beautifully. It's exactly the way everybody planned it to work. It's unfortunate that the guy had passed away. He was only 52 years old. But it happens. It happens a lot. That's where a buy-sell agreement works beautifully, particularly in the case of death. Now, there are insurance people in this room, and they sell not only life insurance, they sell disability insurance or disability buyout insurance. But that's very expensive. And a lot of people don't want to spend the money on the insurance premiums. If you become permanently disabled, you want to be able to get liquidity for your interest. Yes? Always? No. Do you want to always have to be forced to sell your interest? No. I have a client. He's got a $40 million a year tech company growing. He's stepped out of management. He's built a management team around him. He's built his own management succession plan. His estate plan is, hey, I want my wife to just basically come in and be able to receive the distributions from the company. I don't want to have to sell it. How do we incentivize the people who are still there to stay? That's going to be one issue. So we're building that plan right now. But you don't have to sell if you die. You don't have to do that. And so any plan that automatically contemplates a mandatory sale by one of the owners under the buy-sell agreement may be flawed because it may not achieve the owner's objectives. So every plan is different. Buy-sell agreements can work. If you're 100% owner, question.
So is that really based upon sort of size in terms of like the DBO, the disability buyout? Because I mean, at the big size we talked about, he'd already sorted out his succession plan from a management perspective. So that was all there. But I mean, if we're three partners, one of us becomes disabled, and that person was integral in the business in actual fact producing some of the revenue, okay, then that's like almost like death by disability type stuff, you know, in terms of like for the company.
Death by disability. So the question was, to repeat it for those that couldn't hear it, is it really dependent on size as to whether or not you're going to buy disability buyout insurance versus if you have a smaller company and you say you have three owners co-equal, one of them is critical to the operation of the business, wouldn't it make sense to get disability buyout insurance? It really depends on what your co-founders feel about that. If they have to replace this person and he's disabled, it may be good to get some type of disability insurance that's paid into the company on the disability of the individual. And the company would use it like key man insurance to fund the hiring of somebody who would replace this individual. And if it requires that we buy out that interest, we could use disability buyout insurance, or we could use the cash flow of the business to buy it out. And so we'll build in terms into the buy-sell agreement, depending on what the business is and how much cash flow it throws off, as to maybe the company can just buy it out over time. Maybe it's 3 years, 5 years, 7 years, 10 years. Depends on how stable the company is after the death of this one individual. These are all the factors that we would factor in trying to construct the business succession plan. So the terms might facilitate the buyout of the interest just using the cash flow of the company without having to get insurance. Really depends on the business. And this one business that I told you about that has the management team, what he hasn't done his planning on yet is the fact that his company may be worth $30–40 million, which is subject to estate tax. And how is he going to pay the tax? Which gets into some of the advanced planning techniques that we're going to talk about next session. But that's a really important consideration. What is the estate tax that's going to be generated in the entire estate based on all of the assets? And how are we going to pay for it? Are we going to be like Joe Robbie, the former owner of the Miami Dolphins, who died, leaving a very successful real estate empire and the Miami Dolphins, all of which were illiquid? Forced the sale of the Dolphins, all of his real estate holdings at depressed prices to pay the estate taxes. Not a good plan. So yeah, there is planning that has to go into this, and we'll take that into consideration. So each of these factors are dealt with in a buy-sell agreement. A cross-purchase is merely saying, I, the owner, have the right to buy the shares of my co-owner, as opposed to the company buying. That would be a redemption. The benefit of a cross-purchase is, if I buy it from Gary, he's my co-owner, I get a stepped-up basis, a tax basis, for the amount that I paid to him for his ownership interest. So that if I have to go and sell my interest to a third party, my capital gain is reduced because I got that stepped-up basis. Whereas if the company buys the shares, you may not be able to get that, unless it's a partnership and you have a 754 election in effect. What? That's complicated tax talk for saying you need a tax person involved, depending on the structure. Always get a tax person involved to make sure that you're structuring whatever the buyout is to be appropriate. So a redemption is the company's buying out the interest, which essentially increases everybody else's interest. I asked a question before, I didn't get an answer. What if the company is 100% owned by somebody? Well, the simple answer is sell it to somebody else. Sell it to the remaining managers. You might be able to do that. We're trying to structure that with one of our clients right now. Trying to structure a management buyout because he doesn't think a third-party buyout is going to work. You could give them an option to buy shares. You could just give them a small amount of shares, the management team. Depends on what you want to do, how you want to incentivize them, what the value of this is to you and your estate versus to them, what the tax consequences to them of receiving the interest are. If you just give somebody stock out of the company, it's taxable. They have to pay ordinary income tax on the value of the stock that they receive. So valuation is always an issue, always comes up. But the structure, which is simple, the structuring is simple. It's the valuing and the dynamics between the parties that is the difficult part. And that's where just doing a buy-sell agreement is not going to cut it. Just doing a cross-purchase or a redemption or a hybrid agreement of the two is not going to cut it because it's not taking into consideration all the factors that you have to take into consideration when you're transitioning ownership of a business. All right, so we're going backwards, let's go forwards. Forward is good. So the valuation, as I mentioned, is really important. We often use a fixed price. It might be a multiple of revenue, multiple of earnings, multiple of cash flow. It might be based on industry information that we know about. You know, we know that government contractors today expect multiples of 8 to 10 of EBITDA, but if it's a small business or a service-disabled veteran-owned business, it may not even be sellable. The valuation multiples may be severely depressed. If you have one contract in the business, it might be severely depressed. If you're a subcontractor versus a prime, that affects valuation. All of these things get factored in depending on what kind of business you're operating. I'm working with a large real estate management and development company right now. Whole different set of issues. You hear the term cap rate a lot. What do these projects go for? What are they sold for? It's based on their ability to generate cash flow. But it also is based on their condition. You know, if you're dealing with a project like Southern Towers, which is a massive project, but it's old, what kind of investment would have to be made in a project like that to make it even more profitable in the future? What's the capital outlay? These are business decisions that involve business experts that have to be involved in the projections for the business. So it might be a simple formula, it might be an appraisal. I'm not the greatest fan of appraisers only because it's an art, not a science, and you can manipulate any of the factors in the appraisal to get the result that you want. The real true good appraisers will be true to their craft and use as much industry data as they can and back up their assumptions as much as they possibly can, but it's not always accurate. So what I've found in the real world is that appraisals in a good M&A market are generally very low compared to what the company would sell for. In a bad M&A market, they may be too high. So it really, it's based on functions of cash flow, discounted cash flow, assets, tangible assets, depending on what kind of business it is. I had an equipment rental business that we recently sold. A lot of their business was in the equipment inventory that they had built up, and that value was in that particular type of asset, and the buyer focused heavily on that. So it really depends on the business, but it depends on the type and the size of the business. So you want to get an expert involved. The triggering events, again, are disability, death. Divorce is an important one. We've had buy-sell agreements challenged in divorce proceedings. Bankruptcy, you want to build in that into it. And then if we have minority owners who are not family that you're just going to kick out, you have to build in protections for the minority owners in the event that the founder decides to terminate them without any real good reason or without cause. So then we have to get into definitions of what that means. Is it narrow? Is it broad? How do we protect the company? How do we protect the owners? How do we protect the employees who are going to be acquiring these ownership interests? This is much more than a buy-sell agreement. It becomes a shareholders agreement with governance provisions. Who's on the board? Under what circumstances are they elected to the board? And when can they exercise their judgment?